Joining me right now with more, our own Kristina Partsinevelos, along with Kingsview Asset Management CIO Scott Martin. Scott, were you surprised the president made the comment about how he doesn't want interest rates going up?
Yeah, you know, the old fine line between the Oval Office and the Federal Reserve, right, Trish, which are supposed to be pretty separated, at least by a Chinese wall or something. But we all know that, you know, politics do play their way in many, many corners of the world. I'm not surprised. I kind of agree with Donald, though, in the sense of we're on a first-name basis, by the way, now, I guess.
Apparently,
in the sense that I don't disagree as much with the interest rate hikes, Trish, as much as I disagree with the Fed flattening or, in some cases, maybe down the road, inverting the yield curve, because that's when you start looking at the impact on the banks, the impact on the economy, and that's probably what he's more worried about than, say, just the Fed knocking in 2 more rate hikes, which I think we're going to get, by the way, by the end of the year.
Yeah, I mean, Kristina, in some ways, isn't it healthy? I mean, if you've got an improving economy, and we do have an improving economy, don't you want interest rates to start moving up? That should be expected. And by the way, if they don't, what the heck is going on? If no one thinks that, you know, rates are going to be higher 10 years from now, I mean, what is the 10-year right now? We'll show everybody the yield on the 10-year, which is still down in the doldrums.
Right.
I mean, if no one thinks that money's going to be worth more, there, you're still
Let's
below
just
3%.
go out and spend everything. Then,
yeah,
right? Why save?
You know, I just think that it creates some rather unintended consequences when you leave them this low for this long.
Exactly, which is why the Fed has said that they're going to go forward. However, in the beige book that came out, and within that beige book for July, they did say tariffs 31 times. So they are concerned about tariffs. But he did add a new word. And since we're so particular about words these days with the president in Helsinki, there was the word for now. So Jay Powell believes for now the best way forward is to keep gradually rising. So there's a little change that maybe they're not going to be on autopilot with increasing rates over the next little while.
But that might be because of the tariffs, you're saying. In other words, if tariffs are actually, you've got to hope, you've got to pray, right, that consumers are out there spending enough,
right,
because you've got a better economy and there's more optimism out there, Scott, that they're spending, and therefore that offsets any risk to the economy with tariffs. Otherwise, I mean, maybe Jerome, I'll use, we're on a first-name basis, too.
Then it should be Jay, right?
Yeah. If you get in there and you're able to, you know, back off, if he backs off the interest rates moving higher, then maybe that tempers some of the challenges we might find from tariffs.
Yeah, I agree. I think K-Parts mentioned it. I think that the beige book was surprisingly...
Nicknames.
I hope we can say that. You know, the beige book was surprisingly dovish, and the outlook was surprisingly accommodative from the Fed. You know, and I think that's one thing that I think supported stock prices a bit the last couple days, aside from today, because the fact that the Fed said, yeah, for now, we're going to stay on this interest rate hiking path, but we're willing to change. And that, to me, is really the key point here, because you guys know consumption numbers are pretty good. Inflation numbers are pretty good.
Yeah,
they're not too hot. But I'll tell you what's not great. It's right. Their job numbers are good. But I'll tell you what's not that great, in my opinion, as far as our work goes, wage growth numbers. They're going up, yes, but they're still hanging around that 3%. That's not where they should be, given the great pace of job growth we've seen.
Can I ask you, I mean, explain that, though. Why are wages not going up more if workers are that hard to come by right now?
So should we be concerned that right now investments in general, so when you're paying workers higher, that's an investment. And companies as a whole are very worried. They're in a state of uncertainty, flux, because they don't know the outcome of the economy. They don't know what the trade tariff war could potentially have. And so to me, that is the most concerning aspect, this level of uncertainty across the board, and the fact that we complain that there's not enough, well, we American companies, they're not enough employees. So they're finding other ways to retain employees, like adding more perks. Like I've seen this with McDonald's, Walmart, paying for education. But why aren't they giving more money to actual Americans? And so that is a concern. I think that has a lot to do with this uncertainty.
It makes sense, right? Because once you commit to that higher wage, you're kind of stuck.
How are you going to go back?
It's hard to cut people's pay later on down the road. Anyway, Scott, Kristina, thank you so much. Really interesting stuff.